Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn.
Chicago wheat. The break in early October below the August to October ascending wedge pattern, which is highlighted in blue on my daily chart, has been the most recent seminal moment here. 11 weeks ago, I laid out two avenues of what I thought might be the possibilities here for the future. Of these two, the first avenue is the way the market chose, and is why prices are moving lower. To recap my thoughts, here's what I said at the time, and I quote: "The first is the straightforward move down with potential targets for the ascending wedge pattern. Thus, a primary target X on the downside was already achieved in the 860 area, whilst a secondary harder to reach target X1 is way down below in the 712 area. Since then, prices dropped below all the moving averages, and in early December last year, the market pushed below the recent August low at 743, with the lowest low and low close since late September 2021. In the process, it also pushed below the March 2014 high at 724. However, that seemed to be enough for now, as only a little below is a congestion band between 725 and 721. Which has the March 2014 high at 725 and the October 2013 low at 721 within it, and the move down halted there. The end of that fall was very interesting, as it was awfully close to target X1 in the 712 zone. Plus beyond that, well, there is really no clear support until the January 2021 high at 693. Nevertheless, the market chose to stop there on the support and stage a recovery. But even this was limited, as prices only reached up to the overhead congestion created during July and August between 780 to 843. Inside this congestion is the declining short medium moving average, currently 784, and also the slowly declining medium moving average, currently 827. Interestingly, these two made a dead cross, a lagging indicator, in mid-December last year. Anyway, at the start of the year, the market peaked at the congestion and we've moved lower, though this time prices seem to have trouble pushing even through the combination of the August 22 low and May 2014 high at 744. This left us now with two possible scenarios going forward. The primary focus is on what has developed from a bear channel into a descending expanding wedge pattern, highlighted in bright green on my daily chart, originating from October last year and currently 612 to 785. The upper trend line here has the added benefit of the short medium moving average, currently 784, entwined about it right now. There is a further focus, and one that may take up the running from this wedge pattern, and that is to look at the whole May last year to date action as a possible large double bottom, even Eve type possibly. In this action, we could now be forming a second bottom at the moment. Now, my thoughts are that the descending expanding wedge pattern is still leading the market lower, and with the short medium moving average entwined with the upper trend line, then the resistance there ought to be quite good. However, should this trend line and moving average be broken, then looking at a double bottom idea could prove useful, as beyond the July to August last year resistance between 780 to 843, we have nothing of note until the 50% Fibonacci lines at 887 and 891, and also then the declining long moving average currently at 899. Chicago corn. If you start with a headache whilst looking at this daily chart, come join the club. We have jackets. There are still, after many weeks, a lot of things going on here, as you can easily see by the color-coded trend lines. Here are some of the key elements. The firstly is the reverse head and shoulders pattern over July and early August. It turned out at the time to be a good one, especially the slightly optimized neckline, currently at 748, which had been incredibly supportive until the start of November, and led the market higher into a new pattern. Secondly has been the impact of the long moving average, currently 684. I won't go into past details on this, as the current ones are actually interesting enough on their own, with the market being capped at the start of this week in conjunction with another resistance by this very moving average. Then there was the past summer's most important of all, pattern. A pattern which the reverse head and shoulders action had led prices into. The July to October 2022 ascending wedge pattern, highlighted in red trend lines on my daily chart. I personally found this to be the most elegant pattern of all the elements. In mid-October, the market exited this pattern. For a couple of weeks, it seemed the prices were looking to see if there was enough bearish pressure out there to push prices low. Well, there was in November last year, when the market moved lower and laid out primary target X for this break below in the 648 zone, and a secondary harder to reach, much harder to reach, target X1 in the 550 zone. In early December, prices dropped down enough to reach the primary target, and in the process, punching down through what appeared to be a strong triad of support, consisting of the 50% Fibonacci line of the September 2021 to April 2022 move at 661, and the median moving average at the time, currently 674. The move down stopped short of testing the next supports, Fibonacci-based supports, ones in the 622 zone at the start of December last year, before another decline at the end of December. This time caused by a combination of the approach of the long moving average and the congestion overhead between September to October last year. Yet the decline was not as far as in early December, and I suspect this was due to the newly drawn lower time, currently at 657, of the July-December 2022 bullish shift pitchfork, which I've highlighted in bright green. You can see the indecision clearly by the total of 5 consecutive indecisive sessions either side of the January 7th to 8th weekend. And it took last Thursday's big key reversal up to finally break the doldrums. Now this daily key reversal up led to where we are, capped now by the long moving average and another pattern, and it is now about time to discuss this new possible pattern. And that's a November 22 to date reverse head and shoulders pattern for slowly rising neckline, currently at 686. That was coincident earlier this week with the slowly declining long moving average. That is where we are after all that, supported by the lower tine in bright green and capped on top by the neckline and long moving average. Such a situation will not likely last for too long.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.